It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money. Hey, Mark, you know what I think I want to get? I think I want to get a physical stopwatch. Is that old school or what? I mean, I have my phone, but I don't want to have my phone on. I feel very distracted. I don't know about you guys. I'm going to try. You ready for this? I'm going to try to disconnect later in the summer. When I'm on my 2-week vacation, I'm going to really try not to look at email. You think that's dangerous for me, Mark? Why? You think I'll go crazy or I'll just end up with 1,000 emails? I don't know if he says it's going to freak me out. Anyway, hey, today we have a returning guest. His name is Justin Nielsen. He's Market Research Director at Investors Business Daily at IBD. You can find their website at investors.com. And we're talking about some kind of big picture stuff. So let's talk big picture with Justin Nielsen from IBD. So we have brought you back today because it's a little bit more than mid-year. Kind of wanted to get your take on how the macroeconomic cycle impacts investors. Now, you guys at Investors Business Daily do a lot of trading. And last time you were on the show, we were talking about, who is the type of person who should manage his or her own money. And I think that there are a lot of different ways to think about managing your money. And I know that we often will get questions about big picture, like what's going on. And so, we're talking to you right after President Trump announced that the administration is coming up with another $200 billion worth of Chinese imports on which they'd levy a tariff of 10%. And I think this prompted a lot of people to say, oh, my God, we're now really in a trade war. And so let me start with you with that moment, which is if you're an investor and you're worried about this trade conflict escalating, what do you think you should do?
Here, it depends on your time frame.
Right.
If you've got a long-term time frame, this is a blip. It's meaningless. You're not going to be doing anything. You just kind of stick to the course and go with your long-term trading plan. If you are a short-term trader, then everything about the trade wars adds uncertainty. In fact, it was so funny because there was that first round of tariffs, the 25% tariff. And there was the buildup, there's the will he or won't he, the sides being drawn up, who was it for, who was against. And then when the actual event happened, the market was up the next day. It was kind of like the uncertainty had kind of been taken away. Now it was a reality. And it was kind of like, So I think a lot of times with this stuff, the uncertainty does add for extra movement in the market. If you're going to be a short-term trader, yes, you can play that. But if you're a long-term trader, a lot of the stuff it's just a blip on the radar. It's not even a blip sometimes.
And if you were a short-term investor, and let's just say you've got a play money account, what is the view from Investors Business Daily around trying to pick the winners and losers of these tariff conflicts? Are you guys doing that?
You can make all sorts of very smart analysis and back everything up that you've said with all sorts of data. But when it comes down to it, a lot of times we just look at what the stocks are doing.
Mm-hmm.
The stocks, really kind of, when you start seeing who's leading and who's lagging, it becomes very clear what the market is deciding is going to happen. And so there's a lot of that mass psychology, and you can try and second guess it and everything like that. But when it comes down to it, a lot of this stuff is decided by the market as a whole. And you can either be on the right side of that or the wrong side of that. And a lot of times, at least on the short term, this is where charts become very critical. Looking at charts, looking at patterns, because these patterns just repeat themselves over and over and over again. But things change very fluidly in the market, and everyone kind of has all the same information. So it's not until new information comes out that shifts everything. You really kind of figure out what actually happened. I mean, hindsight is the easiest way to do the analysis, because when you're talking hindsight, it's like, oh, of course that's what was going to happen when all of these factors were in place.
Right.
But,
and meanwhile, your emotions are telling you 500 different things, like, you're scared and you're nervous or you're greedy, whatever all those things are, right?
Exactly. So a lot of times it really comes down to the chart and risk management. You can make a lot of mistakes as long as you're keeping your losses small. then you will do fine. One of the stats that we have that is just, it's mind-boggling, but when you look at the leading stocks, the stocks that everyone's talking about, the ones that everyone wants to own, when they top, they tend to go down on average 72%. That's a huge number. And in order to get back from a 72% correction, you have to make almost 300% on your next trade, get back to even, right? So the big thing is just to be not sitting through things that are going through 72% corrections. And so by watching the market, looking at the charts, you kind of avoid those big downturns. You cut your losses, you have risk management rules, and your analysis can be wrong. Things can change, things can be different. And you won't get too hurt. That's the biggest thing.
Have you been surprised about the resilience of the stock market, whatever the index is you want to choose, in light of the trade announcements that have occurred in the first 6.5 months of the year?
I've been shocked with the resilience for years now. I mean, forget the trade wars. Here again, this is where I really had to kind of put my personal opinions to the side. Just looking at what the market was doing, we had this huge move. I mean, really, if you think about it, from 2009, we've had the NASDAQ composite has had maybe a couple times where it's gone down 20% off its high. And even then, it happens for about 5 minutes. It happened in 2011 when there were global recession fears. I think maybe there was a little mini flash crash in 2015, August 2015, where it might have happened. I thought that we were, due for a more serious correction for a long time. And I was completely wrong. So what am I going to do? Am I going to just, plant my flag and say, no, I'm right, and I'm going to wait for the market to agree with me? Or I'm going to look and see what the market is actually doing and adjust what I'm doing based on what the market is doing in reality. So same thing here with the trade fears. My opinion is not nearly as important as what the market does in reaction. And right now, it's certainly not giving me the feeling of, oh, let's be very aggressive because of that uncertainty. And, we've had uncertainty for the entire year. 2018, we're kind of at that halftime report right now. 2018 is a very different year than 2017. Almost no volatility. The S&P 500 barely corrected I think 3.4% was the biggest correction.
Yes, 2017 had low volatility and I think did not have more than you're right, I think not more than a 4% move in either direction.
And it was a pretty big year. It was up.
Yeah.
The S&P 500 was up 20%. So usually, and again, this is just going back historically, usually when you have a strong year like that and the volatility kind of dries up like that, usually your next year, it might be positive, but it's not as strong. Things tend to kind of have a little bit of mean reversion. You have a strong year. It's not always followed by, another strong year. When that starts happening, then you get kind of overblown and you get into the kind of that bubble mentality that we saw in the 1990s or even at the very end of 2007. And that's just not where we're at right now.
We'll get back to our interview with Justin Nielsen in a moment. During the break, why don't you go to our website, JillOnMoney.com? Why don't you sign up for our free weekly newsletter? And if you want to go play a little bit during the break, go check out Investors.com. That's where Justin's from. Investors.com. All right, Jill on Money. We will return in just a moment.
If you've missed any part of a show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
Welcome back. And if you have been just kind of scratching your head about how do the recent actions, trade actions, recent sort of mini moves in the market or big moves, how do they fall in terms of what's really important over time? They fall oh my God, this is unique, or it's kind of just what we expect. Well, I got a good expert for you. Justin Nielsen is back on the show. He's our resident anthropologist turned financial investor guy. He's from Investors Business Daily. The website is investors.com. He's the market research director there. And what's kind of cool is when you do research over the long time, super long time, there are very interesting cycles that become not predictable, but there are certainly patterns. And in this segment with Justin, we're talking about the cycles of markets and where we are right now. I want to just talk about that long term for a second, because you guys at Investors Business Daily, go to investors.com if you want to check it out. You have done a lot of long term analysis. So you've got a bunch of data. Talk about how long these cycles can run, meaning that, we know that the bull market, as you said, it started in March of 2009. And we know that the expansion officially, I'm putting that in quotes, started in June of 2009, even though the employment market didn't really bottom out till 2010. But, if we think about that, we're in the 10th year of this recovery, the second longest on record. We're really have seen enormous gains in the stock market. It's a long time. Is that normal? I mean, these big, you look at the universe in a much longer time horizon. I had heard of something called the bond super cycle. That would be like these multi-decade period where generally interest rates are rising or falling. Are there also super cycles in stocks?
Absolutely. And here again, all you have to do is, if you're looking at a chart, a lot of people might look at daily charts or weekly charts on a daily basis to kind of see what's happening in the stock market. But if you kind of step back and look at monthly charts or even yearly charts, it's amazing how the picture changes. What you see are these kind of what we call super cycles, where you'll have a prolonged uptrend of maybe 15 years, even up to 20 years sometimes. 1982 to 2000 was basically one long super cycle. Sure, you had corrections in between there, but if you look at a yearly chart, it looks like it's just basically going up. Of course, nothing goes up forever, and so you have these areas that are followed by kind of sideways action, where it consolidates and it takes a long time for it to make a new high. And that could be 10, 15 years. Let's just look back recently. We had that big 1982 to 2000 run up. That was one cycle, one up cycle. If you're looking at a yearly chart, you topped in 2000 and it took a long time to get back to the highs that we were at.
Right.
I mean, the NASDAQ topped in March of 2000 above 5,000. It was it was years and years, over a decade before we got to that 5,000 level again in the NASDAQ composite. Now, does that mean that you should have just sat that entire time out? Of course not. 2003 to 2007 was a wonderful time to be investing. There were so many growth names that were working so well. So yeah, you didn't want to sidestep that, but it was still part of that overall consolidation. And you go back the 70s, stagflation, and the 73, 74 bear market. That was one of those sideways times, and it was preceded by the post-World War II boom that happened in the 50s and all the infrastructure growth and the optimism of the 60s. And then before that, what did you have? Oh, you had some sideways action. It was the Depression. Before that, you had the Roaring 20s. That was your up cycle. So you look at that long-term chart and you have these up cycles and these sideways areas. So for anyone that's just starting out, it's kind of exciting. Understand that doesn't mean you're not going to see 20% corrections. It's just that in your long-term plan, those will become very small over a 40-year time frame. Again, just look at 1987. Everyone thinks to Black Monday, and what a devastating day that was. Of course, you're down 20%, more than 20% in a single day. But when you step back and you look at a yearly chart and you look at that move from 1982 to 2000,
it's a nice one.
Yeah, it's a beautiful uptrend. 1987, it's hardly a blip.
You're talking about super cycles on the upside. Are there super cycles that are downsides?
Well, sure. You've got after the 1929 crash, you had the most severe downtrend, and it took a very long time to recover from that. You had a few years where it was very hard to make any money. And then, of course, you had unemployment and that macro perspective. It was very interesting having Ben Bernanke as the Fed chairman, right at the time that he was, because of his study of the Depression. just understanding those macro elements and what not to do, what things to do, because he had devices to use that they didn't have back then. I don't envy the Fed their position of that balancing act. There's a certain element of that going on right now, trying to balance, all of those elements of the economy with this one tool of monetary policy. So, but yeah, you had that cycle, the 70s, as I mentioned, which was a pretty severe bear market. And then, of course, after 2000, now understand, I started investing in the late 90s. So when I started, I thought I was a genius.
You were,
Yeah.
but everyone else was too.
Everyone else was too. And then 2000 hit, and, that was such a severe, correction, the worst that we had since the Great Depression. And I was told that was a once in a lifetime event. And then 2008 rolls around, we have a financial crisis, and it felt like, wait a minute, is this another lifetime event? Because I only had one lifetime last time I checked. So it was.
It's like having a once in 100-year flood, except you've had 3 of them. Let me ask you another thing, just getting back to the uncertainty. And a lot of the questions that we've been fielding recently have to do with this changing backdrop around interest rates. We've just gotten some data showing that inflation is creeping higher, and the Fed has already raised interest rates by 1/4 point twice this year. They're on pace to do it 4 times this year. How do you at Investors Business Daily, and how do you, Justin Nielsen, how do you factor in interest rates when you look at your overall investment portfolio? And I would ask you that as a long-term investor first.
I think that was one of the things that was throwing me so much, a few years ago, is when we were in this phase of quantitative easing and very low interest rates. I think in a lot of ways that was propping up the stock market considerably, because people were looking around and saying, okay, if I'm not putting my money in the stock market, where am I going to put it? Am I going to put it into a savings or CD where I'm going to get, a couple bucks for, the thousands and thousands of dollars I have? It almost forced money into riskier investments than the risk-free investment of treasuries that were paying nothing, or CDs or saving rates. So there were 2 things that were happening. First, it was shutting off the spigot of the quantitative easing, right? Let's stop buying the bonds. And then it was, let's stop, repurchasing bonds to take the place of the ones that are maturing. The question is, where do we go from here now that we've kind of had interest rates get up a little bit? And that's a good thing, because, again, the Fed only has this one monetary policy thing that they can kind of adjust. And if any recession were to happen and our rates were already so low, they really didn't have anything to do. That their barrels were empty. They had already kind of shot everything they had. So, now that we've kind of gotten a little bit more of the Fed raising, and you mentioned the horizon looks like there's going to be more, but there's still that uncertainty of what happens a lot of times when the Fed starts raising rates is they overshoot, they overcorrect. And again, they have a hard job, because the Fed is trying to do something where they're not going to see the effects for 6 months. And that's hard.
We'll get back to our interview with Justin Nielsen in just a minute. If you have a financial question, maybe it has to do with investing, maybe it has to do with something else, give us a holler. Our email address is askjill@jillonmoney.com, and we will be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. All right, now, with our guest today, Justin Nielsen, I decided to attack a question that a few of you, I wouldn't say the vast majority of you, but I would say a few of you have actually asked. It's essentially comparing how short-term government bond yields compare with long-term government bond yields, because there's something called a yield curve. And you're just starting to see some press talking about Flattening yield curve, inverted yield curve. Things are going to be changing soon, and what you need to know as an investor. And this is all going to sound super wonky, and you're going to tune out. But I'm going to tell you something right now. Listen to this one segment with Justin Nielsen, our guest from Investors Business Daily, investors.com, and you are going to know everything you need to know about yield curves. Okay, here's more of our interview with Justin. Again, as a long-term investor, you are just sort of, I think, saying your advice is these things are happening. And even though it might freak you out in the moment to be like, interest rates are rising, I'm scared. Or one guy just wrote in and asked me about the inverted yield curve. And aren't we about to have a recession and shouldn't I go to cash? A yield curve is basically plotting along a chart the yields, the interest you get paid, when you lend the government money on a short-term basis and medium-term and long-term, right? Normally, what does a yield curve look like, Justin?
Well, normally, on the short term, you would pay less yield because you don't have that much time in there. So there's supposedly a little bit more certainty. Now, long term, you start going out 10 years or 30 years, you would expect, hey, I'm going to have to pay a little bit more yield if I'm going to be locking in and committing to paying this yield for that long period of time. I'm going to have to, pay a little bit more because a lot can happen in 10 years, 30 years. So you would expect that the longer term bonds or whatever instrument that you're using, debt instrument you're using, would pay more yield the longer you go out.
So your curve is sloping up to the right, correct?
Yeah. And again, that just makes common sense. If you had an option of getting the same yield at 2 years as you would at 30 years, well, why not take the 2 year and just, see what happens? You can always adjust afterwards. So yeah, that's the way it slopes up.
Okay, so right now the Fed funds rate, which is the short term, is, where are we? At 1.75 to 2? Is that where we are?
That's about right.
That sounds right. And then the 10-year Treasury is at like 2.8-ish, 2.9.
And it was a big deal when that got above 3%, very briefly for a period of time, because that's when it was kind of like, okay, the short term is going up much faster than the 10-year was. So we haven't seen an inversion, but what's happening is that spread between the two it's getting very small. So we call that a flattening yield curve. And when you have a flattening yield curve, of course, the next question is, okay, does that mean we're going to go to an inverted yield curve?
Because, and now why is it so important? What is the important signal that an inverted yield curve would be flashing?
Most people look at the inverted yield curve as a very reliable signal that a recession is coming. Because basically, when you start saying, hey, you know what, I'm going to be paying more yield for the short term, and the long term, I'm not going to pay as much yield because I think things are going to go down, then that kind of means that you're expecting that the economy is going to go down. Because what happens a lot of times is, and it's a lot of this reaction, to reaction to reaction. When you've got your inflation that's finally getting up to the target rate that the Fed sets, then they want to make sure that the market doesn't overheat, that the economy doesn't overheat. And so here again, the way that they can do that is by raising interest rates, because all sorts of things follow along with that. What's weird in this case is you're usually applying a lot of this monetary policy when you're at kind of almost the bottom of recovery and you're trying to stimulate things. Well, we just had this stimulus in a tax reform package. So that's going to be putting some stimulus here. And the concern is, okay, if the Fed is, already feeling like, hey, we're getting close to our target inflation rate, and if we get up more, considerably more, and we've got the stimulus, then beyond 2 years, what are we going to need to do? What is that going to look like? What is that picture going to look like? And the fear is that the Fed is going to be needing to tighten more. And that means that the rates are going to go up, and that impacts all sorts of things downstream. Okay, so now all the corporations that have been used to this low rate environment, they have these borrowing costs, and those are going to go up. It's going to cost more to pay their debts. It's going to cost more for the government to pay their debts because we've got these deficits and, a huge increasing debt. It's going to cost more to service that debt. households, if you've got credit card debt, if you've got any type of debt, it's going to cost more of your income to service that debt. And the question is, what does that money that is going towards debt servicing, what could it have gone to? It could have gone to growing the economy,
Right.
consumer spending, all of those things. You take that element out, and now you're servicing debt and your economy, what's going to grow that? So that's where, okay, long term, maybe these rates, maybe the economy isn't looking so hot. So the long term rates aren't going up as much. And there's also, what do people do when they're scared? If trade wars, North Korea, the global marketplace, you start looking for safe havens. One of the safe havens is the risk-free return that you get from government bonds. And so you start purchasing more of those because you want to be safe, and that raises the bond price and lowers the yield. So it's that inverse relationship. As you buy more of something, in this case, the yield goes down. And so that's what could be also on the horizon for those long-term rates. And that's where people are starting to get concerned. Okay, if we get this inverted yield curve, and that's something that we see, often precedes a recession, well, what do we have on our horizon?
All right, we will get back to our interview with Justin Nielsen in just a moment. In the meantime, you may have something that you need to actually understand better. And if you need to do that, go to our website, JillOnMoney.com. You can read, listen, watch, sign up for our free weekly newsletter. You can also subscribe to our podcast. It's called Better Off. You can get it on our website, Apple, Stitcher, Radio.com, Google Play, just about anywhere you find your favorite podcasts. Okay, we will be back with more of our interview with Justin Nielsen in just a moment.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill@jillonmoney.com, or tweet a question on Twitter using the handle @JillOnMoney. Just use the hashtag AskJill.
You're back with Jill on Money. If you have a question, we really want to hear from you. It would be so great. Just give us a shout. And the shout means an email. Our email address is askjill@jillonmoney.com. Today we're talking a lot about investing. We get a ton of questions about investing, but this is not just an investing show. You know that. But I guess that given all of the news of the day, it's really hard not to try to figure out, like, big picture what's going on and what you should do about it, which is why we have our guest, Justin Nielsen, with us. Justin works over at Investors Business Daily, IBD to many people. The website is investors.com. He is the market research director there. He's also a member of the markets team. And, so far we've been talking a lot about, big picture stuff, what's going on. And I guess that the biggest question people are asking right now is around trade. So when you think about a lot of the policies that are being enacted, 50 billion, 200 billion, steel, aluminum, solar panels, washing machines, where does it all lead? How does it impact you? How does it impact the economy? How does it impact the stock market? All these things are big questions. Some of them are not knowable. Some of them we got some clues to. So let's go talk more with our guest, Justin Nielsen, right now. I want to finish with one question. Do you think that you are a better investor for having lived through a few bear markets?
Absolutely. I think, and unfortunately, as with most things, I think that when you're going through the hard time, it doesn't, you kind of look and say, oh, how could this be a good thing? But in retrospect, you realize, oh, yeah, that helped me. 2000, I actually got out very good in 2000. It was 2001 and 2002 where I was trying to go in too heavy too quickly. That's what really hurt me. And I'm so glad that I had that lesson when I had less money, because, if I had been a few decades into my investing career, making those mistakes would have really hurt. So I'm kind of glad to have some of those mistakes under my belt that I've made already with less money, so that as my account grows, I'm hopefully not going to make the same mistakes with a larger account. And that's the same thing. Getting back to that, I guess the overall theme that we've been talking about today is time frame. If you're starting out in your 20s and 30s, a lot of the stuff just doesn't matter for your long-term horizon. However, if you're getting closer to retirement, I think that's where you could really start worrying and not sleeping at night, because you're worrying about, is my risk too much? And if you see a major correction in the market, and you wait a year to go into more conservative investments, if you have everything kind of on the line in the stock market and you're supposed to retire next year, of course, you're not going to sleep very well.
No. And you know what I would say to that is that even those people, as much as you freak out because you're like, oh, I'm close to retirement, you aren't going to spend every dollar in your portfolio in the year that you retire. You're going to do something very nice for us. You're going to give us a gorgeous investors.com and an IBD chart that we can share with everyone listening to this. I want people to really take a good look at the long-term horizon here. It really does help you not freak out as much. And I think that you're absolutely right, Justin. Just like living through these things, it's not like it's fun, but you're like, oh, okay, well, I can get through this and I will get through this. And oh, by the way, my portfolio recovers because that's what happens. So I don't have to make myself nuts.